Moving averages and overextension. Moving averages are the simplest, most widely used indicators. They're essentially a line plotted on a chart based on the average closing price of the last X number of candles or periods. The most popular moving averages are the 20, which is often coloured blue, the 50, which is typically red, and 200, which is green periods. Price stretches away from MAs as it moves, and like an elastic band, when it gets too far from the moving average, called overextension, there is often a snapback. Hence, spot overextension to avoid entering trades at an unfavourable time. So let's take this chart of BP, and on it we've got a red 50 moving average plotted. If I plot on the overextension periods 1, 2 and 3, you can see the price gets so far before it has to come back to the moving average. It snaps back like an elastic band. Again, so far from the moving average. Now instead of a snapback this time, it just moves sideways whilst waiting for the moving average to catch up. The point being that trying to go long at this point is probably not a good idea, because you're going to have to wait a long time for price to catch up before it has the energy or the elasticity in the band, in our analogy, to move again. And once more it gets so high and it's overextended and it snaps back. We can apply the same principle to the Euro Aussie dollar currency, and again we've got another 50 moving average plotted, and if we plot on the overextension, we can see in this short trade environment we get so far before a snapback, then price falls again before it retraces, more of a sideways move, that one goes with the trend, and then we have quite a vicious snapback, and then we move south again before a more gradual retracement. So the point being, at these overextended periods, it's not worth going short, because there is more chance of a price retracement than there is of a further move. So in summary, all charting software has MA functionality, and they can be applied to any market or time frame. Use them to avoid entering trades when price is overextended from your chosen moving average, and it doesn't really matter which one, and hence when there is risk of a retracement.